Skiba da ba da ba doo ba doo ba dee ba ba boo beep ba dee bee. Yeah.
Hey, folks, and welcome to a fantastic year, 2024, our first episode of Financial Fitness. And as always, folks, I want to thank you for all that you did for us in 2023. James and I with Soaring Profits, we're super excited to have you here today. And as always, we got a great guest. Our whole goal here with Financial Fitness, as before we talk with Joe, is to enlighten folks, have that deeper conversation, bring people that beyond surface level that unfortunately YouTube and so often LinkedIn even just scratches. And our goal with Financial Fitness here is to bring thought leaders to you folks, because it's a dangerous place in the world as far as information on YouTube. Sometimes you get that, first time home buyers information, and that's great. If you've never had anyone in your life that, you had that smart uncle, maybe that financially savvy, dad, as some of those book authors out there so often talk about. But our goal here is to scratch a little bit deeper, get you a little bit more into the pool of what you're doing with your finances and how we're going to move forward. And today, I look at the market, I look, around the holidays, people ate a little bit better than probably they have in a while with that perceived wealth notion. We've watched the cues, we've watched the market rally exponentially since November, when we see the thought of a pivot from the Federal Reserve Bank in the United States. And we've seen just this exponential rocket ship in equities prices. We've seen bond yields fall. We've seen the cost of borrowing soften substantially. And we're looking into 2024 in this kind of, precipice of what is it going to be? Where are we going to be looking at forward? And we find ourselves looking back in the mirror of really 21. What is that going to look like? Where are we going to move from here? So today, before the market, we saw Apple being downgraded. We saw, a number of the NASDAQ equities being, hammered this morning, 2.25, almost 2.33% coming off the table today. And that's risk. That risk is going to be affecting individuals in their pocketbooks and that perceived wealth moving into 2024. But what we're not seeing is bond yields. We're not seeing oil. We're not seeing a lot of these things that we've got to be very cognizant of moving forward. And our risk is really what we have to be hedging against. And I think that brings us perfectly into our guest today. I want to introduce Joe Macek of IA Private Wealth. Joe, thank you so much for joining us. How are you doing today? And how was your holidays, pal?
Thank you so much for having me on this podcast. It's absolutely incredible. I don't, I did have probably about an hour or two. I don't take a whole lot of holidays actually. I'm pretty much working, especially during the winter. I work a ton of hours for clients and for my prospective clients, and also you guys are YouTubers. You understand the additional time commitment that you need in order to put together videos and edit and to be able to create content. So I'm doing that as well. So I don't have a whole lot of holidays, but especially during the winter. But thank you for asking. It's been great. So yeah.
Joe, first of all, hang on a second, because I want to plug your channel, because
Sure.
you like us, our YouTube content creators, you're putting out content, and you are in Manitoba, correct?
Yes, I am.
So now Manitoba is the capital of YouTube content creation, from what I hear, internationally. So how did you first of all jump into the YouTube content creation and then focusing on that wealth creation space?
So I actually hopped into YouTube and okay. So let me back up to the wealth creation space, which I first got into this business as a marketing assistant, helping out advisors in 1998, and became licensed in 2000. So I have
perfect timing.
exactly, like, I believe here's a funny story. All right. I think I got licensed like May 5th, 2000, which is like the absolute apex of the NASDAQ. I think it hit 5,040 points that day. And pretty much every client that I had talked to was down for the next 3 years. And by the way, That's a real bear market for those young people out there that think they went through a bear market in March of like 2020. That's a flesh wound. Okay.
Right.
That's nothing.
Yeah.
From 2000 to 2003, we went through this huge U-shaped recovery. It was so painful as an advisor to go through that and try to convince people to continue to buy through that time frame.
Yeah.
That was a real bear market, like the worst. It was worse than 2008, in my opinion. It was worse than 2020. It was a really, really bad time. All right. So having said that, I think I got licensed right at the apex, and then kind of made it through it and grew, and it was a wonderful time to be an advisor at that time, because the internet was just starting. We went through 2020, which was crazy because everybody thought the world was going to shut down because of the 2-digit thing on Windows, right? That never happened. Like, it was just kind of a wild, awesome time. And a lot of billionaires were made out of that time. Amazon was trading at 2,000 times. Research in Motion was trading at 2,000 times earnings. Okay, like absolutely insane valuations.
That's
So yeah,
crazy.
that was my intro. And then I started doing YouTube about I want to say 3 years ago. And man, was I terrible. I mean, my first, oh my first few videos, if I shared them, they're beyond awful. So if there's any aspiring YouTubers out there that actually want to kind of get on camera and get in front of a camera and like do it,
Yeah.
just know that they cannot be worse than my first videos that were ever done. Like, they were terrible. But
I see, John, I love that. First of all, for the fact that James and I have done that. When we first started, it was literally an audio phone in the middle of us, and it was like, hit play, let's have this conversation. But Joe, I really do mean this, is that it just takes that jump to start, that hit play and see where you come up with. And now, you're a few years later, you've created some pretty interesting content. You've obviously caught our eye here with financial fitness and soaring profits. So you must be doing something right. So how are you using that and creating that knowledge base for your clients? Because again, like I said in my, beginning preamble here, is that we talked about risk in the market. And when you are going through downturns, whether you're, everything that goes up comes down, everything that goes down is going to rally and come back up at some point. So your whole piece is managing risk, but it's also about expectation management and understanding what's kind of coming next. So when you're talking with your clients, how do you use social media marketing? How do you use YouTube to weather some of those big storms, whether they be down, whether they be up? How do you use that for expectation management with your clients?
oh, you know what? What a great question. YouTube saved my life. Okay. I'm going to tell you why YouTube saved my life. All right. Okay. So for 25 years, I've been meeting with clients and prospective clients. And the first thing that they want to talk about is, what's your view on the markets? And,
Right.
as much as I love the markets, and I'm exceptionally passionate about, you have to be in this position, right? I'm very passionate about the markets. But, okay, after 25 years, and if you have 200, 300 families that you are counseling, okay, and you're meeting with them 3 to 4 times a year, and you're talking about the same thing over and over and over again, it gets really old really fast.
Yeah.
So one of the things that I love doing is I love putting together my market commentaries for every quarter. And what that does is it allows me to put my thoughts together in a scripted format where I can get approval from my sales communication department. And by the way, everything on my channel, just to kind of a side note, everything on my channel is highly regulated. Okay.
Right.
I can't just talk about whatever I want. I can't make recommendations. There are billions of YouTubers out there that are financial wizards that are making these buy these stocks today
Right.
videos. And I'm a licensed fiduciary. I'm a portfolio manager. So every piece of content that I have to put out there has to go through my sales communications department, and they approve what I'm saying. And what they look for is they make sure I'm not making any guarantees.
Right.
All right. That's a really good red flag. If you're meeting with an advisor, okay, and they say, yeah, I guarantee you 15%, you should get up, walk right out of the room, because you know what? They're not allowed to say that. You cannot guarantee performance for obvious reasons, right? So YouTube has saved my life because I put together those market commentaries for my clients. And then after I put that together, I send it out ahead of our meetings. And I say, look, this is my market thoughts. Okay. Please watch this video. This is my market thought. If you don't watch it, we're not going to be talking about the markets in our meetings. We're going to be talking about you.
Right.
We're going to be talking about how the markets, how we're going to use the markets and able to get you where you need to be, which is essentially passing away with money in your pocket. That's my job, is to make sure that you die with money in your pocket. You don't want to die before, have your money run out before you die. That's bad. Okay. You want to have lots left over so you can send it to your heirs or whatever. And that's really what we do. So it saves me a ton of time, and clients can rewind and watch YouTube. They can, if something goes over their head, they can rewind it. They can look it up. It's YouTube has saved my life from that standpoint.
Well, for sure. And you bring up so many points there in regards to the ability to take large concepts. People can rewind it. They can watch it at their pace. That, something that I've been talking about a ton over the last little while, Joe, is the fact that, we've got bond yield issues, and you can just see people glaze over. Like, they fall asleep. They're like, what does a quarter point in bond yields mean? And I'm like, billions and trillions of dollars, right? The liquidity that is being dried up because of, quantitative tightening, gone. Like, they're just asleep. There's nothing sexy. There's no Lamborghinis. Like, it is not hot. No. But if you can get there, if you can understand that topic and why it bleeds into the economy, why it affects lending, why it's, you see the Silicon Valley bank crisis that we saw early last year was because we saw this exponential bond yield problem that, have we figured out yet? Where do we go from here? And it's like that sexy. Like, if you can call these banking crises before, there's a lot of money to be made. And again, like you're saying, is that you're not here to call tops and bottoms. You're here to make sure that your people weather those storms and that they're able to ride through that. And maybe you can talk a little bit more about how in practice that you are hedging for your folks, making sure that your people are set up to, again, you don't have to hit home runs every time, but you're just not striking out.
Yeah. So you brought up quite a few things in there. So you brought up bond market. Okay. So let's talk about the bond market. Bond market is, I don't know, 5 to 10 times bigger than the stock market. And there's a lot smarter people in the bond market than there is the stock market. Okay. So if you want to know, this is an old saying. I picked this up from mentorship in I used to sit, here's a story. There's a well-known building, and there's a well-known, it was called Bleachers. Okay. And they have it was called the Vendome. And we would go there, and I would sit there with these older advisors, and they would tell stories about how they'd buy these stocks and get completely screwed on these stocks. Right? So I learned what not to do in the stock market from 15, 20 mentors sitting there having
not a bad way to start out. If you're going to have some advisors, as long as they're throwing you stuff not to do, not a bad way to start off. Yeah.
Yeah. Like, they would talk about the Austin chalk in Texas and and how the formations were different down there, and how Canadians went down and bought some of these lands, and they sold them, and like lots of really great stories. Cool. So the bond market is a lot smarter than the stock market. So if you want to know what the stock market is probably going to do, it's not foolproof. You should be looking at the bond market. Right. And that's a very counterintuitive thing. Now, you brought up quantitative tightening and you brought up yields. Well, trying to explain the yield curve to a retail client is, it's difficult because they don't have the knowledge. They're hiring me for the knowledge, right? So trying to explain that, and that's where I use video quite a bit, because I talk about the yield curve, but I also talk about the asset balance sheet rolling off as well in my market commentary. So there's two levers that the Federal Reserve right now is using. And by the way, we exclusively kind of focus on the US because the US has 50% of the world's market capitalization. Yep. We have like 3%. So the tail is not going to wag the dog here. Okay. The big dog is the United States. They have all the money, and that's where we watch, because if the US catches a cold, the whole world's going to sneeze. We're going to sneeze along with it. So we're very tied to what the US is doing. So that kind of covers the bond market yield curve kind of thing that I think you were kind of chatting about. And then you've got all kinds of other things like, we're on recession watch for right now. We've been on recession watch since October 18th of 2022.
Yeah.
We're looking for that big decline because the yield curve has never been more inverted. And that yield curve has had a wonderful track record of sniffing out collapses and recessions. So we're very
Joe, with that being said, though, why? And again, I come back to this, and I have my opinions, and we've talked at great deal about this on the show. But why do you think that we are seeing all-time highs as we're running through this recession watch, like you're talking?
I think there was a lot of money, trillions and trillions and trillions of dollars, and you can see it in the savings rates. You can see it in the checkable deposits. If you guys watch any of my market commentaries on my YouTube channel, I cover the checkable deposits. I cover the savings rates. I cover all that from the consumer, because the consumer is 70% of the US economy. So if you have a healthy consumer, you have a healthy economy.
Right.
And there was so much printed during COVID. It was incredible, the amount of money that was created through the balance sheet and printed. And we are running through that capital. All right. And eventually, what will happen is we will run out of that capital. And at some point,
Yeah.
things change. Now, the billion-dollar question is, or the trillion-dollar question is, can the Federal Reserve organize and orchestrate a soft landing, which they've only done it one time in 1994?
Now, do you even call that a soft landing? Is that a real? I struggle with that one, because again, I look at it in that instance, the one soft landing, we had none of the precipitating causes that we have now.
No, we don't. And I'm somewhat skeptical of that too. And that's the best part about being an advisor. One of my mentors told me, Joe, you got to be a cynic and a believer all at the same time when you're in the stock market.
I like that. That's a good one.
Never really understood that until later on in life. You've got to be a cynic and a believer when you're buying a stock. You've got to be a cynic and a believer when you're talking about the market. You've got to look at both sides, right? Now, could they do it? Anything can happen in the market. Let's go back to rule number one. Anything, and I do mean anything, can happen in the stock, in any market, anything. I never thought I would see negative oil prices in 2020. Negative oil prices. People were paying you to take their delivery of their oil. So, that just goes to show you that anything can happen. So if you start with anything can happen, then you go, okay, what else can happen? All right. Then you start to try to drill down. And you mentioned risk mitigation. Well, yeah. If there's, it really depends on what kind of investor you are. If you're a beginning investor, you really don't necessarily, you want to mitigate risk, but you don't really, like, if you really didn't want to mitigate risk when you're like 20 years old, you don't need to. Right. You probably have almost no money invested in the market because you're just starting to work. So you might have $100, $200, $1,000. And let's say you had 10 grand in the market at 20 years old, and you lost 56% like in 2003. Well, you've got to make up $5,600 over the next 45 years.
Right.
You're not, if you got zero growth, you could do that. Okay.
Yeah. Just inflationary expectations. You're going to do that. Yeah.
Right. So you don't really, I don't want to say you don't have to mitigate risk when you're young, but you can buy the S&P 500, right? As an ETF, you could. It's not a recommendation. You could buy it. And yeah, it's 30% high tech stock, super valuation, NVIDIA and all that. And you could probably be okay, right? But when you're 64, and you have 3 million at risk or 5 million because you built it up over 30, 40 years,
Yeah.
to take a 56% hit right before you go into retirement is pretty insane, I would think, you know?
So Joe, when you're dealing with your clients, and let's give you a kind of a figurative thing. You've got a 64-year-old who is, hedging on retirement, owns their own business, has created a pot, let's call it a 6-figure pot. What are you putting people into? What are you suggesting in that fictitious realm to be able to mitigate risk, but also maximize return for individuals?
Yeah, so we do own we own great businesses, okay? But when it comes to owning great, and we also own some private credit and private equity, which you have to be an accredited investor for, right? Accredited investor means you need like $1 million in investable assets and all this kind of stuff. But being a portfolio manager and being a fiduciary, I can become, for someone with 300 or 500,000, I can become the accredited investor on their behalf. Okay. So they don't need to be an accredited investor. I can do that for them. And we build a portfolio with, a percentage of private equity, private credit that it doesn't typically get valued every day like the market does.
Right.
And then we have some individual stocks that we have that move up and down with the market and then we have, some fixed income in there, and we have, so the volatility is really mitigated. The other thing for young for young investors, I think the number one thing is it's all weighting. Okay, how much of a percentage of your overall account do you own in any particular stock?
Right.
If you go above 10%, and I have this on my YouTube channel with the 10% rule, that's my 10% rule. I never go above that.
Yep.
I shouldn't say never, but almost never go above that. You never really want to have too much of a good thing in your portfolio. You want to mitigate that risk, and the higher the risk, the lower the weighting. So if you got a really high risk stock in your portfolio or something that you view as high risk, you probably want to only go 2, 3, 4% of your overall portfolio max.
So you're saying you weren't all in on GameStop here 2 years ago when everything rallied and was running? That wasn't like an 80% holding or like that?
No. There's another saying that we have in the business: sex belongs in your portfolio, sex belongs in the bedroom, not in your portfolio.
I like that. That's a good one. Yeah.
So the sexier a stock is, it probably does not belong in your portfolio. Okay. So that said, I think what you want to do is, having said that, I think, with the GameStop kind of era, whenever something hits the news, you kind of want to be very careful about investing in anything like that. I think if you buy great businesses, and you'll know what those great businesses are, most of your investors are going to know what those great businesses are, and you do it within a reasonable weighting, and you don't chew off too much in terms of risk, I think you're going to be fine.
Right.
I think you're going to be fine.
Now, I would be remiss having someone of your status and being here today with us to ask you where you think, the 2024 direction, whether you're looking at some bull trends or you're going to be looking at some bear traps. Do you think that we are falling back into a potential bear lag? I talked about in my preamble earlier today in regards to Apple being downgraded. There's so much manipulation that's occurring in the market, and the old adage that the market can be irrational longer than you can be solvent. And that's where I look at a lot of the things that are happening in the last 2.5 months, where it seemed like we were in a very healthy pullback and then skyrocketing with this AI mania. Do you think that the artificial intelligence mania run up, do you think that it is going to be powerful into 2024? And do you think that Magnificent Seven is going to continue having legs and carrying us through into this election year?
Oh, that's such a great question. So first off, nobody knows. So nobody can know what, I mean, and when you talk, I don't think anybody knows, and I really don't know. But what I can say is there's really two markets here, right? There's your Magnificent Seven, which is driven. I mean, the NASDAQ was up something like 43% last year. Okay.
Crazy. Yeah.
The Dow Jones was not even close to that.
No.
So you have all these, we used to call them the old economy stocks and the new economy stocks.
Right.
2000, I'm dating myself now, but you've got a lot of these interest sensitives like, Canadian banks, REITs, all these interest sensitives that have been, pretty depressed. And then you've got these magnificent seven stocks that have just taken off regardless of valuation.
Yeah.
Now, AI, and I want to back up a bit because the companies that I really, really like, okay, are the ones that have really good intelligence, someone at the helm that is amazingly smart and can execute. Well, you've got 3 or 4 companies right now that have artificial intelligence and supercomputers that are smarter than any human that has ever existed in its entirety. All right, like Google's DeepMind.
Mm-hmm.
One of the videos that I watched, I don't know if you've ever seen it or not, but it's an hour and a half, and I would highly recommend anybody watch this video if you really want to know what DeepMind is all about. Watch AlphaGo on YouTube. It's an hour and a half.
Okay.
It talks about how they develop DeepMind to play the game of Go, and the game of Go is a huge game in the Asian community, and they were laughing at the fact that they were going to try to get artificial intelligence to take on this project because there are more moves in Go than there are atoms in the universe.
Wow.
So you cannot supercompute this thing. You have to use artificial intelligence. Wow. And I won't ruin the story for you, but if you really want to know how amazing that kind of artificial intelligence is, watch that video. And this is a 5 or 6 year old video. It'll blow your mind. So, I mean, I think artificial intelligence, any company that has that kind of brain power and that kind of compute, I mean, Google just plugged DeepMind into their heating and cooling, and they save 30% on their heating and cooling. So, I mean, they just gave away, DeepMind just gave away, they had to map like 200 million proteins. DeepMind just, it took humans, like humans can't do this, okay? It took 50 years for humans to even try to predict a protein. DeepMind did it in 4 hours. Okay. And
James, you're out of a job, pal. Just giving you a heads up. Or you've been replaced. I appreciate you. Our producer James here, he's in the background. I don't know what he's gonna do, but he's out. That's it.
I'm just saying, they did it in 4 hours, and not only that, they mapped all 200 million proteins and they donated it to science. So now doctors are working on these proteins that have been done from DeepMind and artificial intelligence. So AI is real. What you're willing to pay for that's
the kick.
That is a giant question mark for me, because it's like, man, it is so incredible, but man, the valuations are pretty steep. I think right now the valuations on the Magnificent Seven are 45 times earnings on average. Pretty heavy valuation. So
when you've seen that and you came through the tech bubble, the .com bubble of the early 2000s, do you have a bit of hesitation going all in on an NVIDIA or an AMD and riding this wave until the players shake themselves out? Or do they become a little bit of a forefront because they're going to be the chip side? They're going to be the platform like a Microsoft when they first came out. They were the platform that allowed the tech to run. Whereas, there's going to be a lot of winners. There's going to be even more losers. Like I saw this morning that we had a big deal with Airbnb has purchased an artificial intelligence side of their business, and they're all in on it, and they're very tech secretive of what they're doing. If I can't tell you that I want to go to Paris on a vacation, I don't know how artificial intelligence is going to flesh that out for me quite yet. You got a proof of stake before I jump all in on reinvesting in a housing rental business, potentially on a real estate bubble. There's a lot to weigh in there in regards to what is the return on that artificial intelligence technology. So do you think that maybe the AMDs, the NVIDIAs are going to be the forefront play of this? Or what are even your customers saying around this? Because obviously they are being told that there's some wild stuff coming and how to jump in early and often.
Yeah, again, so lots to unpack there. Artificial intelligence, you need the chips, and you like NVIDIA, in that space seems to be one of the huge leaders. I mean, AMD is right behind them. But NVIDIA seems to be making these chips and charging whatever they want. That's
whatever they want. Yeah, pricing power, huge.
Then you have, Elon Musk saying, yeah, we're very happy to, we just bought, I don't know, they bought 10,000 of those the highest end processors they could possibly buy for the Dojo computer for Tesla, right? So, and he's like, yeah, we'd be happy to buy more. And now Tesla's supposed to be going into building their own chips. So and here's the other thing that I think some people are missing about compute. The amount of power that you need to run a supercomputer is not small. I just watched a video on this last night. I really wish I could find it. I think it was from the YouTuber, The Tesla Space.
Okay.
It was entitled something along the lines of what a supercomputer does. And one of the supercomputers that they were talking about was Frontier. Okay. Now Frontier, they were talking about exaflops and all these kind of flops. I'm not really a computer guy, but apparently a lot of flops are good. Okay.
The more flops. Got it. All right.
The more flops you have, the more incredible your machine is.
Awesome.
Now, this computer, Frontier, uses as much power as 50,000 homes.
Wow.
Okay. So we're going to need electricity. Okay. And I've seen Sam Altman, I think it was Sam Altman in an interview saying, yeah, by the time 2040 rolls around with all the artificial intelligence and the chips that we're doing, if we continue down this road, all of the compute in the world will take up all of the electricity that's being generated right now. We won't even have electricity to run like your toaster.
Crazy.
So you need you need power. Frontier uses water to cool it, by the way, like gallons of water to cool it. It needs tons of electricity, tons of water, and tons of tons of cabinet space, and it is the world's supercomputer. So getting back to your thing, I think all of this kind of meshes together. You need the chips, you need the software, you need Alphabet and the software developers to develop software, and then now AI can create the software, and AI can do all these things. So I really do think this is very similar to 2000, where the internet was just coming in. I think the artificial intelligence revolution is just beginning, but it is accelerating far faster than the internet ever did, far faster. It took 20 years. I think I don't know how long it took for payments to become mainstream. But I lived in a day where people didn't want to put their credit card online.
Yes.
Right. Now it's second nature.
You're right. People
do that. They'd rather pay online than go to the store. Right. So similar to elevator operators at the turn of the century, when there was an automated elevator, you didn't want to go into that automated elevator, but now it's second nature. You would think it's weird that there would be an elevator operator there. So I think with AI, I think there's a lot of things right now that are apprehensive, but I think in about 5 to 10 years, I think you're going to look at AI and go, oh my God, why would you ever do your own scripting for video?
Absolutely. And opening that opportunity up for the thought leaders of spaces is going to be wild. When everything first started, the first thought I had was, the legal world. You're going to see the eradication of secretaries. Every time I go in and deal with my lawyer on any matter, I deal with a secretary. Now that's gone. That individual is no longer there. What is that going to pivot into? Because now they can do it just from their laptop. So AI is going to be amazing. It's going to be a revolution. Are we going to see the mass layoffs that everyone is concerned about? Are we going to see the rundown on like the HR side of things, that we're going to see massive labor shortages? I don't think so. I think it's going to end up probably similarly to what we saw with the .com situation, is that they're going to pivot. You're going to have new industries that are going to roll off. And I think that's going to be positive. But I think there's going to be a disruptive piece that's going to come. You're probably going to see a side of that that's going to pop unemployment. And then that kind of leads into where we are now. If we see a pop in unemployment, does the Fed have to respond? Do we see that over the next 2 years leading into a reset going through this? And you were talking about energy, you were talking about water, you were talking about all this sort of thing. And I would be remiss if I didn't have you for a second and ask you your thoughts on the spot ETF for Bitcoin that they are going to be throwing out here. What is your opinion, first of all, on Bitcoin, and then cryptocurrencies abroad as a topic? What do you think?
Well, so I don't own any cryptocurrencies whatsoever. It just, my philosophy doesn't really allow me to go into that space.
Right.
I think the technology is absolutely fantastic. But I like to buy businesses that if the stock market were to shut down tomorrow, I would still be able to make money with that business.
Right.
So, and you know, the stock market shuts down on Friday. Google on Saturday owns YouTube, and there's billions of uploads on Saturday and billions of uploads on Sunday.
Right.
All right. So that, to me, that business continues to work. Right. And I'm not obviously recommending Google for anybody here, but
right.
I'm just using Google as an example where YouTube continues to work as a business and charge for advertising and do all this stuff on a Saturday and Sunday, even though the stock market is shut down. Right. So Bitcoin doesn't produce a dividend. There's no business in Bitcoin. So, and you know, I don't own it. I heard about it at $10, never bought it. I heard it about $100, never bought it. I heard about it at $1,000.
So you're not in at 60,000, you don't think?
I'm not in at 60,000, and maybe it goes to 400,000. I don't know. Okay, but I'm not going to buy it then either. Okay, I like buying businesses that if the stock market shuts down, they're going to make money no matter what. So that's kind of what I like. You know, no matter if there's a market open for the business, they're going to continue to go out and make money, or at least try to make money, right?
Joe, I love it. I want to thank you so much for joining us tonight. How do people get in touch with you to work with you and your organization, and kind of flog yourself a little bit? Tell them where they can find you on YouTube as well.
Man, that was quick, and I had a lot of fun. So I hope
we have a lot of fun. It's what we do here.
All right. So how do you get a hold of me? You can actually just scan the QR code that goes right to my YouTube channel, and there's you pick almost any video there, and there's a contact me, and that'll get right, that email will get sent right to me. You can go to my website, joemacek.com. And the best part is we don't start charging any prospective clients until they actually decide that they want to work with me. So if you're out there, there's many studies out there that have shown that working with an advisor, you can get up to 2 to 3 times the net worth as opposed to going it alone. And you're a lot less anxious and you're a lot more happy dealing with an advisor out there. So now, if you're obviously comfortable trading and doing everything you're on your own, that's great. Like, not a problem. But if you are one of those people that, kind of want to get some help, yeah, absolutely. Come out and join me on the YouTube channel. Please subscribe and comment, because I do answer the comments, and everything's great. And thank you so much for having me.
He's even doing my sales pitch. You got to do the like and subscribe and share so we can keep going out, getting great guys like Joe and bringing that knowledge base. And first of all, Joe, I want to thank you so much, pal. Again, that flew by, almost 40 minutes into this now, but you're exactly right with what you're saying. Is it doesn't matter if you're the Robinhood accountant of the United States, you're Wealthsimple here in Canada, whatever you're throwing into that is that you're taking a step in the right direction of your future. And someone like yourself is able to jump in on that harness, maybe talk a little bit about tax incentives. What's that going to look like when you're, dealing with your families one day after you're gone? That's a huge thing. And It's easy to click buy and sell when we look at these charts and we look at all of the chartists out there, that kind of what I love doing and enjoy doing. But someone like yourself is able to step in there and fill in a lot of the voids of knowledge because you're dealing with it every day. If you're a welder, if you're a sailor, if you're in the army, it doesn't matter what you're doing. When you bring that check home and you decide to put it into the market, you want to be able to sleep at night. And someone like Joe is able to help you. He's able to take a lot of that problem that, did I make the right decision, lowering and mitigating that risk. That's an invaluable thing in the market right now. And as you folks know, the profiteers out there, you know where I sort of think we are in the market cycle. I think there's a lot of money sitting on the sidelines. I am not saying to buy anything specifically, but when you see a downgrade on Apple this morning, the market goes back 2.25% in an afternoon, erasing 12 days of gains. We're probably going to see some downside potential here. Position yourself accordingly. Joe, thank you again, my friend. It was a pleasure having you. And as always, folks, let's make some money together, folks.